And small companies have outperformed because they've grown faster than large companies. And so this happens because they're smaller companies. And there is, through cycles, this creative destruction where the smaller companies end up being more nimble to be able to adapt new technologies, to be disruptive to the incumbent companies, which ultimately leads to faster growth.
Welcome to WellSaid, conversations with Wellington Management investment professionals about the intersection of financial markets, geopolitics, and long-term research. I'm your host, Thomas Mucha. Vladimir Lenin once reputedly said, "There are decades when nothing happens, and there are weeks where decades happen." The events of the past few weeks have upended U.S. markets, the outlook for the economy, and potentially the entire political and geopolitical landscapes. July's cooler inflation print, rising odds of a September Fed rate cut, the assassination attempt on Donald Trump, the historic shakeup for the Democrats in the 2024 presidential race, and there's still a long way to go until November. Now, while it's not clear that these events will have decades-long consequences, of course, the effects will surely be felt for quite some time. This is a massive topic, so we're going to touch on these things briefly, but focus on a market segment that has had a historic rotation in reaction to these macro jolts. And here, of course, I'm talking about small cap stocks. I'm joined by Andy Heiskell, Wellington's global equity strategist, a former portfolio manager, and a 23-year veteran of the firm. Andy, welcome to WellSaid, and thanks for helping us break all of this down.
Thanks for having me, Thomas.
Obviously, Andy, there's a lot to unpack, but first, explain what you do as global equity strategist and who you work most closely with.
So as Wellington's global equity strategist, I have two really complementary functions. First, I work internally, think sort of as sitting horizontally across our public equities business. And we have 25 equity investment teams, and I work day to day with them, helping them to navigate all the complexities of investment markets, helping to answer questions, identify trends, and probably most importantly, to discover new opportunities. And then secondly, complementary to this, I work externally with our clients and our partners, and I guess unsurprisingly, helping to answer and address the same questions and trends. And I say these are complementary because the questions and issues that we're trying to debate and trying to answer internally are exactly what our clients and partners are trying to answer and debate as well. And so those conversations that we have internally are very informative for me and helping to lead those conversations I have with our clients. And then those external conversations I have simultaneously are very helpful in terms of helping to instruct that conversation internally.
What you just said is an exact mirror of my role at the firm, too. I'm meeting with those same 25 investment teams. I'm meeting with a lot of these same clients, and I do think there's a really nice symbiotic relationship between the internal and the external piece of it.
Yes.
All right, Andy, now on to the specifics of today's conversation. And let's start with the dizzying events that I just mentioned, seen through the lens of the stock market. So please explain to us what happened, why did it happen, and why did small caps rebound so dramatically?
Yeah, this rotation between small caps and large caps in recent weeks really has been historic. It really was triggered beginning on July 11th when we saw the surprisingly low CPI print, which really is important for small cap stocks. We've seen this really significant negative correlation between small cap stocks and interest rates in the markets in recent years, really because small companies have become more exposed to higher interest rates. Small companies have higher leverage, they have a lot of floating rate debt, and they have been more pressured by the Fed rate actions and higher interest rates. So the CPI has come in lower. That's increased expectations that the Fed will be cutting interest rates into the back half of this year, alleviating some of this pressure on small companies. And then you combine this together with, some positive economic data, retail sales, GDP, and then lastly, the increasing prospects of Donald Trump and Republican sweep combined together have really caught a lot of investors sort of on the wrong side of positioning and sentiment. And so these have all combined together to really create this historic reversal that we've seen.
You've been doing this a long time. Have you ever seen something so dramatic in your 23-year career?
It happens at times, but it usually happens exactly at these moments where sentiment is in position or really sort of tilted towards one side of the boat. Everybody's in one trade, and the trade recently has been really around the Magnificent Seven, the large cap stocks, AI, A lot of investors have been caught off sides here.
Yeah. Well, on the topic of the Mag 7 trade, you've been saying for some time that on the other side of this, when the biggest tech names end their run, you anticipate a prolonged period of outperformance by small companies. Do you think that an inflection point is underway, or could this be more of a blip that hints that the market is primed for reversal, but it's still early?
I would describe it as an inflecting point. We discuss a lot internally about regime change, whether it's regime change around the economy or regime change around the market. And I like just to reiterate that a regime change is a process. It's not an event, right? And so what we've seen here recently is an event. And so really the process takes time. And so if we think through the key components of regime change, have to go, what we discussed earlier, have to do with sentiment, positioning, valuation, which had been on the side of small caps here recently. But the last component, which is probably the most important ultimately, is around fundamentals. And this is where small companies have been, as I said, particularly impacted by the higher interest rates in the Fed policy. And so just this last year alone, we've seen earnings go down by over 20% for small companies. We've seen revenues go down 6%. And this is in the midst of a GDP that's been growing nominally 5-6%. So pretty striking, adverse economic and earnings impacts for small companies. So to see really a true reversal, we need to see this true reversal in terms of the fundamentals. We need to see the closing of the earnings growth gap between the large companies and the small companies. And that will take time.
Weeks, months, quarters?
I would say quarters and years. And our anticipation is that we'll start to see some of this gap close into the back half of 2024, but really probably accelerate into 2025.
So to take the other side of that, why shouldn't investors assume that the structural dominance of these massive, powerful companies will continue? What's the argument here for small caps, really?
So I'll caveat by saying that we do view favorably a lot of these large companies. They are outstanding companies. They are world-class. They're growing more quickly than the market. They're delivering tremendous growth in profits and free cash flows. They have low debt. There's a lot of attributes to love about these mega-cap companies. But that being said, I think there's really two important attributes here that we need to take into consideration. The first is the law of large numbers has not been suspended. And I get legitimate questions at times where people ask, well, what if these companies that are bigger than average continue to grow faster than the average company? And I pause and I say, well, how does that work, right? If you're bigger than average, you can't grow faster than average forever, right? Eventually, the only outcome of that is you'd have one company left. So that law of large numbers still remains in place. I'd say the other law that we need to keep into consideration is really the law of creative destruction. Over a long period of time, like 100 years, small companies have outperformed large companies. And small companies have outperformed because they've grown faster than large companies. And so this happens because they're smaller companies. And there is, through cycles, this creative destruction where the smaller companies end up being more nimble to be able to adapt new technologies, to be disruptive to the incumbent companies, which ultimately leads to faster growth.
Yeah, that makes sense. And I like your point. It's not an either or here between large and small caps, right? There's a wide array of options here from an investment perspective. Now, let's dig into this a bit. If you look at a historical chart of outperformance and underperformance relative to large caps, the inflection points marking changes in leadership are pretty sharp. They're fairly unmistakable. So what are some past examples of catalysts that benefited small caps, and what should investors be looking for this time around, apart from what you said earlier about interest rates?
Historically, looking back again over long cycles, small companies tend to outperform early economic cycle. So they are clearly viewed as early cycle stocks, early cycle sectors. And what I mean by this is after recession, you typically have a period of accelerating economic growth where these small companies are disproportionate beneficiaries. They're winners there. And I think the complication that investors have been facing the last 4 or 5 years is that the cycle has been anything but normal, right? We had a downturn, a recession because of pandemic. And subsequent, we've had rebounds that have been sparked by really aggressive monetary and fiscal policy. And then we've had worries about a subsequent downturn. So we've been really vacillating back and forth, I would argue, between sort of mid and late cycle for the past 4 or 5 years.
Yeah, it's weird out there.
And we haven't had a true sort of early cycle period other than maybe for a quarter or two in 2020. And so there really hasn't been the normal opportunity for investors to engage or re-engage with small cap stocks. And I think at this moment in time, a lot of investors are waiting for this signal, this bell to be rung to say it's safe to go back into the water. I'd argue that we might not have that this time, that because of this sort of disruption of the normal cycle, it might play through a bit differently. We're not going to have maybe the sharp rotation that we've seen in cycles past, but rather, again, it will be this process that lasts or takes several quarters or maybe even a couple years of an improvement of the relative profit growth of small companies. And as that comes through, that will be the driver, I think, of the closing of this relative gap of performance between large and small.
You mentioned small caps being more nimble. Do you think management of small caps can be more nimble in managing the economic uncertainty resulting from the pandemic that you referred to?
I think the key important point here is that there's an increased bifurcation of quality of small companies. And what I mean by this is there are a growing amount of small companies that are very economically vulnerable. They're highly indebted, have high leverage, have floating rate debt that are very sensitive to the impacts of higher interest rates. I think these companies have less flexibility. And those are the parts of the market that are very vulnerable. But I think the important component here is that there's a growing bifurcation in the quality of small companies. That yes, on average, small companies have more debt, have more leverage, but that debt and leverage is highly concentrated in a small percentage of small cap companies. So half of the debt, interestingly, of small companies is concentrated in only 15% of small cap companies. So highly, highly concentrated. Conversely, 35% of small companies have no debt at all. So those are the companies that have the flexibility to be able to be adaptable. And so in our research process, it's a matter of trying to identify those winners and losers, the vulnerable and those that have that ability to take advantage of it.
Yeah, you have to know where to look.
Yes.
Let's move to the topic of alpha and beta. And small caps are generally attractive for active investors, given the breadth of the opportunity set, the lack of analyst coverage that you sometimes have, and so on. Now, those characteristics, though, Andy, also make it a challenging area for idea discovery. So what are the best practices for identifying these opportunities and capturing alpha within small caps?
There's no silver bullet here. Really, to identify opportunities in small caps is a lot of hard work. And it's a lot of hard work from the bottom up. And so you really need to dig in and identify the companies. There's not a model you can run that's just going to give you the winners and losers. And so really it's a matter of having a bottom-up fundamental process to know the companies, to know who the winners are, to know the sectors, to know all the intricacies, to be able to identify.
So it's an ideal time for active management.
Yes.
So this leads me to an obvious follow-up, Andy. So where are some of the most interesting opportunities in small caps today that are generated from this bottom-up process that you just described?
Yeah, today the most interesting opportunities are in those sectors that really have the most number of companies, that really are the most complex, and also the ones that I say would be the most vulnerable to the technological change and opportunity that exists in the economy today. So this would be areas like biotech, fintech, even within technology itself, where you have a large number of companies that will be highly disrupted, where you'll have significant winners, but you also have significant losers. You also have an extraordinary amount of technological and technical complexity. So if we think of a sector like biotech, right now there's over 150 biotech stocks in the Russell 2000. These are very small companies, very complex technologies, with a very bifurcated outcome in terms of they're either going to be tremendously successful or they'll be dramatic failures. And so there's only one way to go about to identify those winners and losers is to know the companies one by one, to identify them and figure out who the winners and losers are. And so these are the sectors really that present the most interesting opportunities today.
How has the growth of private equity affected public market small cap investing? Because a lot of what you just mentioned is also existent on that side of the equation. So what's the impact here? What's the intersection?
Yeah, this has been a really dramatic impact. I'd say modestly positive, but in some regards has been pretty significantly negative for public small companies the last couple of decades.
Why do you think that is?
So let's put a few numbers to this. I mean, it's really fascinating. But if we look back 20 years ago, in the United States, there were 5,000 listed public companies, and there were less than 1,000 companies owned by private equity. Roll forward to today, there's actually over 10,000 companies currently owned by private equity, and there's only 4,000 public companies. So we've seen this tremendous shift from public to private. So what I say is, that's a positive and a negative. Well, in some regards, the positive is that private equity has been a big buyer of public companies, right? They've been taking companies private. And if you're a shareholder, you've typically been taken out at a premium. So that's been good. But on the negative, as more companies sit in the private space, as a public market investor, it just reduces your opportunity set. And we have seen in some cases companies staying private longer and longer. The classic example that we all know about is Uber, right? Uber didn't become a public company until it had a $50 billion market cap. So if you're a public small cap investor, you never had a chance to invest in Uber. So that is a negative, but I think what's quite interesting right now is as we've seen this tremendous growth of private equity, that increase from 1,000 companies privately owned to 10,000 plus companies privately owned, we have to think forward. What happens to these 10,000 companies, right? Private equity has long-term committed capital, but in many cases they don't have permanent capital, right? So these 10,000 companies need to find some exit. There needs to be a monetization event. And historically, the monetization event for private equity has been either to sell to another private equity firm, maybe sell to a strategic buyer, an industry buyer, or to sell to public markets. So if we look at these 10,000 plus companies owned by private equity, a good portion of them will need to eventually find their way into public markets. And think about the ratio of this. 10,000 private companies, only 4,000 public. So as a public market investor, I'd argue that the supply-demand characteristics or the supply-demand dynamics will be increasingly coming in our favor. And that as these companies are listed in public markets, small cap investors can be discerning in terms of identifying the best companies at the best price.
Sounds like this is a long-term horizon trend, right? Do you agree with that, like over years?
Years, many years. And I would argue it took 2 decades to get to this current position. And it'll probably take another decade or 2 decades to find where the equilibrium is and how this plays out.
So, Andy, we can't avoid my favorite topic, geopolitics and markets. So while I have you here, in our fractured, and I would argue high-risk geopolitical environment, a number of mega caps, whether in tech and AI, semiconductors, legacy defense innovation, other strategic sectors. Now, they're being seen by their respective governments, Washington, D.C. included, as national security assets. So much so that maybe the idea of antitrust regulation might seem almost quaint. So let's cast this forward in the political context. How does Democratic versus Republican leadership change that structural trajectory in your mind and the effects on small caps?
I would say it's an increasingly muddled situation where we're seeing a blending of some national security and populism between both sides of the aisle, right? And if we thought like historically, we would say, well, the Republicans are more in favor of business. But today we see this growing trend towards populism across both parties. I completely agree with your premise that there is a national security aspect to these large mega cap companies that is increasingly important for geopolitical reasons. And because of that, I do agree with this notion that there will be probably some sector of like protection for the parts of these companies that is most strategic and most important to national defense. Within this, specifically areas around AI. But I would also say on the other side of this, that aspect of populism will be, I think, increasingly looking at the consumer sides of these mega cap companies. So I think you could actually see a really interesting situation where there is protection of these companies on one aspect, but also an increased sort of focus of regulation and antitrust on the other parts of their businesses.
That's interesting. You don't hear too many people conflate great power competition with rising protectionism through that lens. How do you think that the impact of the election might change that direction?
Again, I think that's one that's probably more conflicting than what we would have said historically because of this notion of populism that's rising into play. I do think that, again, like the aspect that will be drawn most into question or the biggest scrutiny is most potentially around the consumer sides of these businesses, where it's viewed that these companies have growing market power over consumers in a way that is adverse to the political and consumer interests.
Are there any sectors in the national security context that you think favor small caps? And here I mean emerging technologies. There are a lot of small companies working in AI, defense innovation, right? We have all sorts of changes in military doctrines, those tend to be towards smaller companies. Would you agree that the opportunity set for small companies is growing given the intense focus on national security?
Yeah, I definitely agree with that. And we think about where are the key components of national security interest. It lies around AI, it lies around computer chip technology, it lies around energy production, biotechnology. And these are all the key areas we go back to thinking about where these opportunities are. You have winners and losers, you have disruption, you have a lot of complexity within technological change. I think that the key technologies, the key companies in the small cap spectrum across these areas will be the key components that will be the beneficiaries of this national political interest.
And this is a global trend, too. It's not just U.S. small caps, right? These are global small caps.
Definitely, yes.
All right, Andy. Now, you've been here for 23 years. You've seen Wellington grow from a small company to a relatively large one. You've certainly become a leader at the firm. So what have you learned on this journey about yourself and about what good companies need to do as they grow?
I'd say the most important thing I've learned is that careers are not linear. And I think the same thing is true for a company as well and the growth trajectory of a company. And that there's economic cycles, but there's also aspects of opportunity and disruption that happen. And to be able to adapt to that sort of nonlinearity requires, I'd say, a curiosity and a flexibility.
Well, you certainly exhibit those characteristics, Andy. Thanks again for joining us here on WellSaid. Once again, Andy Heiskell is Wellington's Global Equity Strategist.
Thank you, Thomas. This has been great.
The WellSaid podcast is a Wellington Management production. Our producers are Colin Hopkins, Mark Murphy, and Dana Wickstead. Editorial support from Colin Hopkins and Dana Wickstead. The show is recorded, mixed, and edited by Mark Murphy. Animation support from Rasa Sermonte. Production support from Dave Crow. You can listen to WellSaid at wellington.com and at most podcast platforms. Thanks for listening.
All investing involves risk, including potential loss of principal. Past results are not a reliable indicator of future results. Forward-looking statements should not be considered as guarantees or predictions of future events. This material was current as of the publication date. Wellington assumes no duty to update the content in the event that the information changes. This commentary is provided for informational purposes only. It is not research that is required to be prepared in accordance with the legal requirements designed to promote the independence of investment research. It is not subject to any prohibition on dealing ahead of the dissemination of investment research. It should not be viewed as a current or past recommendation and is not intended to constitute investment advice or an offer to sell or the solicitation of an offer to purchase any securities. It does not take into account the investment objectives, financial situation, or needs of any particular person. Wellington Management does not provide legal, tax, or accounting advice. The views expressed are those of the speaker and may not reflect the views of others at Wellington. This recording may not be reproduced or distributed in whole or in part for any purpose without the express written consent of Wellington Management. Please refer to the disclosure section of this podcast for complete details.